markets hold their breath, key data and earnings on the horizon. Today, the global financial markets are feeling a bit like a calm before the storm, as traders tread carefully in anticipation of some major economic news. Investors are keeping a close eye on the upcoming quarterly earnings reports from four giants of the tech world: Amazon, Apple, Meta Platforms, and Microsoft. But that's not all. Crucial economic indicators are also on the way, including GDP figures from the US and Eurozone, non-farm payrolls from the US, and the Eurozone's flash inflation data. These releases are set to shed light on how recent trade tensions are impacting the economy. The mood in the markets is caught in a tug-of-war between optimism and pessimism. On one hand, there's a growing concern about a potential global recession, fueled by escalating trade disruptions. A recent Reuters poll revealed that 3/4 of economists have lowered their growth forecasts for 2025, now predicting a median growth rate of just 2.7%, down from 3% a few months ago. Alarmingly, 60% of those surveyed believe the risk of a global recession this year is either high or very high. Investors are eagerly awaiting this week's economic data to either confirm or dispel these rising fears. Yet, amidst the gloom, there's a flicker of hope. A breakthrough in ongoing trade negotiations could quickly shift the sentiment in the markets. U.S. Treasury Secretary Scott Bessent pointed out that it's up to China to ease tensions, noting that their trade surplus with the U.S. makes the current tariff situation unsustainable. He also hinted that India might soon be one of the first countries to finalize a new trade agreement with the U.S., which could provide the much-needed boost to market confidence. In the currency markets, the New Zealand dollar, Kiwi, is lagging behind, followed closely by the Swiss franc and the Canadian dollar loonie. On the flip side, the Japanese yen is leading the pack, with the British pound and the Australian dollar also showing strength. The US dollar and euro are hanging in the middle, waiting for direction. From a technical perspective, the AUD/NZD pair is showing signs of recovery, suggesting that a short-term bottom may have formed at 1.0649, supported by bullish signals in the 4-hour MACD. A stronger rally seems likely in the near term, but the outlook remains bearish as long as the 38.2% retracement level at 1.0849 holds. If the current consolidation phase ends, another decline below 1.0649 could be on the horizon, especially if the Reserve Bank of Australia opts for quicker rate cuts in response to a weakening economy. Turning our gaze to Europe, the FTSE is up 0.16%, the DAX has gained 0.55%, and the CAC is up 0.87%. Meanwhile, the UK 10-year yield has risen by 0.039 to 4.521, and Germany's 10-year yield is up 0.052 to 2.515. Earlier in Asia, the Nikkei rose by 0.38%, while the Hong Kong HSI and China's Shanghai SSE saw slight declines of -0.04% and -0.20%, respectively. The International Monetary Fund, IMF, has issued a warning that U.S. tariffs will outweigh the benefits of Germany's stimulus measures, suggesting that while increased infrastructure spending in Germany will provide some support, it won't be enough to counteract the negative effects of U.S. trade policies. Alfred Kammer, the IMF's European Department Director, emphasized that it's the tariffs and trade tensions that are weighing heavily on the economic outlook, rather than any positive fiscal effects. The IMF has made significant downward adjustments to growth forecasts for Europe's advanced economies, and even steeper cuts for emerging Eurozone countries over the next 2 years. They now project Eurozone growth to be just 0.8% in 2025 and 1.2% in 2026, down by 0.2% for each of the next 2 years. Kammer also provided a clear recommendation for the European Central Bank, ECB, suggesting that there's room for one more 25 basis point rate cut this summer, after which rates should stabilize around 2%, unless major shocks occur. In a more optimistic tone, French ECB Governing Council member François Villeroy de Galhau reassured that there's no immediate recession risk for France or Europe, even as inflation continues to decline. He reiterated that the ECB has a gradual margin for rate cuts, despite the global uncertainties. However, he also cautioned against the risks posed by U.S. trade policies, criticizing the protectionist stance that he believes is detrimental to both the US and global economies, ultimately leading to less growth and more inflation. Meanwhile, China is standing firm on its growth target of around 5% for the year, promising to implement timely support measures as it navigates a full-blown trade war with the US. However, no major stimulus has been announced yet, indicating that Beijing is taking a cautious approach, preferring to assess the timing and impact of trade shocks before rolling out large-scale interventions. Zhao Chenxin, deputy head of the National Development and Reform Commission, emphasized that China has ample policy reserves and plenty of policy space to stabilize employment and enhance public employment services. At a recent Politburo meeting chaired by President Xi Jinping, officials called for a timely reduction in interest rates and reserve requirement ratios to support the economy, along with additional measures to assist struggling businesses and boost consumption among middle and lower-income groups. In a positive note, recent official data showed that China's industrial profits returned to growth in the first quarter, with cumulative profits rising 0.8% year-on-year to 1.5 trillion Chinese yuan, reversing a previous decline of -0.3% seen in the first 2 months. As for the pound sterling to US dollar outlook, the intraday bias has turned neutral with today's recovery. The correction from the short-term top at 1.3422 could still extend, and a break below 1.3232 would shift the bias back to the downside. However, any downside movement should be contained by the 38.2% retracement level at 1.2917. On the upside, a firm break above the resistance zone at 1.3422/33 would resume the larger upward trend. In the broader picture, the price actions from 1.3433 are viewed as a corrective pattern within the uptrend that began from the low of 1.3051 in 2022. The rise from January 2099 could either signal a resumption of the uptrend or represent the second leg of a consolidation pattern. Overall, pound sterling to US dollar is expected to target the key resistance level of 1.4248, the 2021 high, once a break above 1.3433 occurs in the future. Stay tuned for the latest economic indicators and market movements as we navigate through these uncertain times.